This is the perfect segue into introducing to you one of the world's leading insurance experts. He is the global head of reinsurance for catastrophic risk modeling for Guy Carpenter Reinsurance. And he's here today. He flew in from Europe to be with us today to give this talk. So we really welcome Guillermo Franco.
Thank you. Thank you. That's overly generous. I'm not. I am just part of the reinsurance community. Certainly, my background is in research. I'm an engineer by training. I joined the insurance industry. Great, and the laser. Perfect. Thank you. I joined the insurance industry from academia, and I didn't know what I was going to find. I thought I was going to find it boring. I had no idea about what insurance was about, but I've been in the industry for about 20 years. I find it fascinating, and the main ideas that I wanted to transmit to you today is the new types of products that we're developing in the industry to respond to this demand for more risk transfer. As I speak, please interrupt me and let me know if you have any questions. We are in the midst of all this debate that Patty talked about, right, regarding bringing capital to sustain catastrophe risk transfer for regions like Florida. So while I won't have answers to all the questions, if you have curiosities or if you want to learn about certain things, maybe I'll be able to give you at least some guidance. Before I start talking about that stuff, I wanted to show you this. I'm an optimist, but this slide is not very optimistic. This is an extract from a report that we call the Global Risk Report. This is something that our company sponsors every year. It comes out of the World Economic Forum in Davos, Switzerland, and it's a survey. It's a survey of about 1,500 CEOs and risk managers and people who do thought leadership in risk assessment, risk management, forecasting, and so on and so forth. They're asked very simple questions. They have to rank what are the risks that they see dominating their decision-making, dominating their time. And they ask them to do that for two time frames, for the next 2 years and for the next 10 years. And you see the list there. Maybe the text is little, but I'll give you the general gist. The general gist is that while people recognize very well that we're facing very important risks in the long term, dealing with catastrophes, dealing with climate warming, etc., we are distracted. We are distracted because we are thinking of impending crisis, many times created by humans, sometimes for power, for greed, and so on and so forth. Some people refer to them before. And knowing our human nature, they appear, they recur, but maybe the tragedy is that when these people who are the experts recognize that we should be focused on the column on the right, we actually are wasting time, you could say, focusing on some issues on the left. The little table there that you see, those are the current topics that they're thinking about. So these leaders of the industry in risk management are not thinking about climate change only. As a matter of fact, those topics are below the five bigger topics that they're thinking about. They're thinking about energy crisis. They're thinking about cost of living crisis. They're thinking about rising inflation, about food supply, and they're thinking about cyber attacks. So when I read it, it was a bit disappointing, right? Because this is telling us that, yeah, we recognize that these other bigger planetary risks are there and recognized, but we don't have time to deal with them because we have to deal with this other stuff. So I just wanted to show you this. The report is available online if you want to look for it. So I wanted to talk about three major drivers within the insurance industry. These are drivers that put pressure on the insurance industry, and I just wanted to walk you through them. Some of them have been referred to previously. And we can, digest them or discuss them as much as you wish. I'll give you a little bit of my perspective on this. There's three major pressures on the industry today. One is the increasing risks, right? We've talked in the morning about all of that. All of these presentations that you've seen in the morning, these are the same presentations that the insurance leaders are listening to. So if you had an insurance company, if you're the CEO of an insurance company, and somebody comes and asks you, can you please insure this town in Florida, what would you say, right? This is the question that they are being asked. And the answer many times is, sorry, no. I mean, the risk is just too enormous, right? These people have to report earnings every quarter. So I cannot expose my company to a drop in share value that drastically if I have a big loss in Florida from all these hurricanes that they're telling me are gonna come with more intensity and with more frequency. The only alternative that remains is raising prices. The only way I can justify this decision to my shareholders is to raise prices. I can tell them that this is an opportunity, that it's risky, but that we're gonna make money, right? I work in the reinsurance domain, so to speak. So our clients are insurance companies, right? We look for capacity to reinsure insurance companies who are the ones who sell us the policies in the retail market, us and companies, right? And these reinsurance companies dictate pricing to a very large extent. These reinsurance companies perform a very important mission in the risk transfer world. They are aggregators, and they distribute the risk. These bigger companies are based in, it could be Lloyd's of London, it could be Munich Re, it could be Swiss Re. These companies insure insurance companies in Japan against earthquake. They insure California companies against earthquakes. They insure Florida companies against hurricanes. And by doing that, they diversify their risk, right? The chances of losing money because there's been an earthquake in California at the same time that there's been an earthquake in Japan, at the same time that there's been a hurricane in Florida is very, very, very little. So by spreading their bets, they kind of normalize their performance, which is what they're seeking. Now, in the reinsurance market, we talk about peak zones. And there's 3 peak zones in the world that are recognized globally. One is California earthquake, the other one is Japan earthquake, and the third one is Florida hurricane. And actually, if I had to rank them in order of importance, probably Florida is at the top. So Florida hurricane, even, it may seem from our perspective here today that it's a state issue, a local issue. Well, no, it's a global issue. Because if we have a hurricane that destroys a lot of exposure in Miami, the prices for insurance are gonna be raised, but not for Florida, for everybody else. So a hurricane in Florida affects the market to such an extent that all the prices experience an impact. So you're not alone. Everybody in the industry is watching Florida hurricane, doing these risk assessments, looking at the possibility of storm surge and all these things that we talked about this morning. So risk is a big driving force. The second one is increasing interest rates. So we have inflation, of course. As a consequence, money becomes more expensive, so interest rates increase. That means that now investors have choices, right? In a time when interest rates are low, when the money is cheap, investors, to make money, one of the things they go to is to insurance, in particular catastrophe insurance. Catastrophe insurance in times of cheap money has paid really well to investors, right? These are people who say, okay, you have to be, in order to invest in what we call cat bonds, catastrophe bonds, you have to have at least $100 million in assets, and you have to say, okay, I'm gonna invest my money in these funds. These funds pay if there is a catastrophe, and if not, they make me a profit, an interest, a spread. And that has been historically pretty competitive. So we have attracted capital into the insurance market through these vehicles. That's positive at the end of the day because we need this money in order to fund the issuance of policies, right? Now, with interest rates going up, capital becomes more expensive. Now they're getting other investment vehicles that pay them a good interest rate without the catastrophe risk, right? So guess what? Investment in catastrophe risk transfer is suffering, is decreasing, right? The reason why I was in London is because I was talking to some of these funds to convince them that there are still opportunities in our market, that they should still keep some money there, right? So this is a second pressure. So even though we need insurance, everybody wants insurance, right? We wanna be able to buy a house without having to lose it all if we lose the house, right? We need that. But accessing this insurance is becoming harder because of this competition with other investment vehicles. Finally, social inflation. This affects mainly Florida, right? And Patty has already described what it is, but just to repeat the concept here, this is weird, right? It's an anomaly, but it has affected insurance here locally very, very, very much. This means that if there's a hurricane and you have only a couple shingles that are broken, somebody will knock on your door, and these are companies that specialize in legal processes. They're companies built of lawyers, not engineers, or they partner with a roof contractor. They knock and they say, hey, you got some damage. Yeah, I have 2 shingles. Well, if you give us your policy, if you assign the benefits of your policy to us, we're gonna take the insurance company to court, and we're gonna recover money for the whole roof and a new kitchen and the door, right? And the fact of the matter is they do, because the insurance companies sometimes, assailed by these lawsuits, they cannot respond to all of them. They're not prepared for this assault, right? So they accept their terms many times. They sacrifice. They say, okay, look, all these people that are claiming the whole limit of the policy, we're just gonna yield because it costs us even more money to start paying for litigation costs and lawyers and so on and so forth. So, well, what is the consequence? Yes, you get a new roof and a new kitchen, but the next year, you're not gonna get insurance, right? Because companies are gonna say, well, I mean, what is the business here? If every policy I sell in Florida, it's 100% loss, almost guaranteed. Every time a hurricane hits, I'm just gonna get out of the market. Patty is right that has been partially addressed in the legislation. So there was a law passed that is still, I believe it still has to come into effect, and it needs amendments, but that is a first step towards resolving this third problem. So these 3 pressures dominate every conversation, especially here in Florida, about insurance. Any questions on any of these 3? Okay. All right, so just very basic concepts about insurance, and I use this example of a fund. We've been talking to state funds or states who want to build a fund. A fund is basically a pot of money, right, to pay to people to recover their livelihoods after the impact of a catastrophe. So you can think of this fund as a state fund. You can think of it as a local fund for the town. You can think of it as your fund, right? We can think of this risk management as a personal fund. So let's suppose that we are talking about a person. So you have some pot of money, and if you have no insurance, you need to have a pot of money big enough to basically pay for damages that you can experience, right? So everything comes from your fund. If you lose your house, you have to be able to repair it or rebuild it, so that comes all from your pocket. Why do we buy insurance? Well, we buy insurance because it allows us to have a smaller fund in our pocket, right? We don't need, if we have a $1 million house and we lose it in a hurricane, if we have insurance, we don't have to have 1 million in the bank to rebuild it, right? We have been paying a policy, we've paid whatever we've paid every year, and that guarantees, or we think it guarantees, that the insurance company is gonna come and rebuild us that $1 million house without us having to keep $1 billion in our pocket. That's the scheme in the upper right-hand side. Of course, we pay a premium for that, right? That's a service. We'll go later into the meaning of these rings around the fund. But that's the basic concept. Now, in an increasing risk landscape, which is where we are, right? More hurricanes, more intense climate warming, and so on and so forth. Our risk is increasing. Therefore, the fund that we need to have in our pockets has to be bigger because the chances of experiencing damages are increasing. Now, the mitigation, all these things that we also talk about, nature-based solutions, sea walls, retreat from the coastline, all of these things are mitigation measures, and what the effect that they have is that they reduce the fund, right? They expose us to less risk. So these are, we talk typically about retention. That's one strategy of risk management. You retain the risk, you pay for it, or we talk about transfer, and insurance is one way to transfer the risk. All right, so now let me talk about what I came to talk about, which was, now I have no time, but quickly I wanted to show you, Bob said we're going to talk about solutions. We are coming up with systems to develop insurance policies that are more amenable to some uses that we see in demand, and also that are amenable to bringing more capital into the insurance industry, right? That these tools are attractive not only to people who receive the coverage, but to companies who give it. And they're based on measurements. So they're called parametric insurance. Can I see a show of hands to see who has heard about parametric insurance before? Anybody? No? Completely new? Okay, good. One? All right. All right. You got an advantage. Excellent. All right, well, it's new. These solutions appeared in the late 90s. I think the first transaction that was done on this basis was in 1997. It was to cover risk from actually at Disneyland Park in Tokyo, Japan. And it consisted of a big circle around Tokyo. And the contract read as follows. If there is an earthquake of magnitude 7 point something or higher within that circle, with an epicenter in that circle, then Disneyland receives X million dollars. If that doesn't happen, then the people who buy or who sell this bond, they get an interest on the money that they put at risk, right? So it was interesting because the investors said, oh, wow, look at this. Now, with that type of contract, I am investing, I am playing in the insurance world. I'm putting my money to work in insurance, but I'm not an insurer. I don't have to have a claims operation. I don't have to hire an army of adjusters to go to Tokyo and figure out if Disneyland had damages or not. Because the only thing that matters is that there's an earthquake in this circle. Wait a second, who's going to tell me if there's an earthquake in that circle? Well, the USGS, minutes after an earthquake, or seconds sometimes, publishes the location of the earthquake and the magnitude of the earthquake, and it's free. Paid by the US Geological Survey, by our taxes, right? So suddenly, we have a system that allows investors to deploy money with very, very, very small frictional costs and make money in the insurance world, right? This was a revolution because it gave investors an asset class that is not correlated with the rest of the market. You see, the correlation between an earthquake and the price of gas, zero, right? So suddenly you have an asset class that gives you diversification no matter where you are. So people came back and said, wait a second. I mean, if I can buy earthquake in Japan, can I buy earthquake in California? Can I buy floods in Europe? Can I buy? And the answer is, well, maybe, right? So there is demand for these types of assets, which is good for our market. It means we have more influx of capacity to issue policies. What do they feed off? Well, this one for earthquake feeds from the systems put in place by the USGS, but in general, this class of assets exists thanks to our ability to measure things. So you can structure these policies in case there is too much rain, because we have pluviometers that measure how much rain falls in one particular spot. We have also satellite systems that tell us in real time. You can go online and see at a website called FIRMS, it's managed by NASA, what spots in the world are being affected right now by a wildfire. So now I can go to an investor and tell them, look, we're going to make a bet based on this. If NASA detects there's a wildfire here, in this box, you're going to pay me some money. If there isn't, you're going to get some interest in exchange. So this instrumentation, these technical advances are making it possible for people to transfer risk more fluidly in the market. Who buys these things, right? I mean, okay, well, we don't buy them, right? You cannot go to your broker and say, hey, I want a parametric policy to cover myself for this and that and that. You cannot buy them today yet, but you will be able to buy them. As a matter of fact, there's a couple companies who are starting to do this in the retail market. In California, you can buy a policy up to $10,000 to protect yourself from earthquakes, and it's based on the level of shaking at a particular location. But in general, who buys these things? Well, it's governments. We've been selling these tools to Mexico since 2006. Every year, they buy about $300 million to protect themselves from earthquakes and hurricanes, right? Who else buys them? Well, Kaiser Permanente, we just did the biggest transaction we've ever done for them. It was almost $500 million, and it protects them from earthquakes all around the coast, all the West Coast, right? Somebody was mentioning before that they were moving from Florida to Washington State. I had some news to them. I mean, now they're going to be subjected to earthquakes, so nothing is perfect. But so all these entities are buying these types of, if you will, they look like derivatives, right? If something happens, I get money. But why do they find them helpful? Well, they find them helpful because of three things. First of all, they pay super fast. You know, in Christchurch in New Zealand, I think it was 2011, there were a couple earthquakes, and you know, a lot of damage. Houses sunk. There was high saturation in the soil, so a lot of water. And the earthquake, when it shakes soil that is highly saturated, the soil becomes a viscous fluid. So houses sunk. And the insurers, when the people called them and said, hey, you know, my house sunk, they said, oh, that's not earthquake damage. I said, what? I said, no, your house sunk. I mean, that's not an earthquake. Well, it took a battle. Yeah? It took 5 years to argue in court that no, that was the earthquake, right? The earthquake shook the soil and the house sunk into the soil. This doesn't happen with these tools. There's an earthquake, it happens at a particular location, we measure where it is, we know how big it was, and you go to an Excel spreadsheet that says, okay, if there's an earthquake in this region with this magnitude, you get paid a certain amount of money. Super fast. For a company, that's wonderful, right? Because I can go to my CFO and say, hey, I'm the risk manager, and I say, hey, Guillermo, you know, hey, what's going to happen after this earthquake? Well, I can tell him or her that we're going to get $100 million next week from this policy. So we have that money in our pocket to do things, to restore operations. For a hospital manager like Kaiser Permanente, that means that they can transport injured people from one hospital to the next. They can bring in doctors from elsewhere. They can helicopter people around. They're going to have a ton of expenses because of the earthquake. Also because there's going to be a higher demand for hospital services. So all of these things are appealing to companies like Kaiser. Now, what do they look like? I described the one for earthquake, but switching gears to hurricane. These are two policies that Mexico has bought over the years. What I'm going to show you after this is the newest version of these things, which is something that we are spearheading at the company. We're trying to make this new tool available to as many companies as possible. But basically, in the past, they consisted of gates here on the left or polygons on the right. So how does this work? Well, the contract reads that if there's a hurricane that hits, in this case, the eastern coast, the Caribbean coast of Mexico, then depending on what gate, which one of these segments it hits at landfall, you're going to go to a table. You're going to say, okay, I'm going to go to the table for A9 because it hit that segment down there, right in the Yucatan Peninsula. And then there's a table that says, well, if the wind speed reported at landfall was such and such, then the policy pays this amount of money. Okay, that's okay. Then you have the right, the policy on the right was a Actually, this one, I think this one was prior. So the one on the right is a bit older. But it said there's going to be these two big polygons, one on the west coast, one on the east coast. And if the hurricane hits any part of this polygon, then you go to the corresponding table and you see what happens. So you see that on the west coast of Mexico, you had just one big box. If anything hit that box, you will go to that table and so on and so forth. Now, what these tools look like today is something like this. And this is something that we can now calibrate much better. We have better models, we have more experience, we have more measurements. And what you're seeing here is basically a real-time index of loss for a hurricane. Well, I'm going to show you some examples for Florida in a second, but this is for a client we're working with in Georgia. Now, they said this is a town in Georgia. They know they're at risk of hurricane impacts, and they have accumulated a fund. And they have a few $1 million just in case the hurricane hits. But that means that they have this pot of money that they cannot use, right? Because they have to have it there. So remember the strategies that I showed you before regarding risk transfer? They have thought that they could buy a policy instead and then liberate part of that fund to do other things in the town, right? Sewage and other things that they need. So they're looking at a solution like this. What you see here is at the top, you see a map showing the trajectory of the hurricane. This is public data that you can get from NOAA, and they report it in real time. And then in the middle, you see a profile of wind speed. So this is a plot that tells you how strong the wind intensity is at any point of the track. And then at the bottom plot, you see a curve that stays at 0, but then once it hits the area of interest, it starts jumping up, right? This is a loss index, and it follows a very simple equation that we calibrate, but basically it tries to approximate the loss that the town is going to be subjected to if a hurricane hits. We just, this last year, we have a client who is a US company, but they bought some coverage for some operations that they have in Manila, in the Philippines. They bought one of these, and then during the summer, Typhoon Noru hit Manila, and we were able to be on the phone with them, basically tracking the hurricane in real time and telling them how much they were going to get paid a week after the hurricane dissipated. This is revolutionary, right, in terms of risk management in a company. I mean, the fact that they knew, right, in a few days that they were going to get paid this after impact, that gives them enormous power to take action, right? So these things are important. They provide speed. They provide transparency. You see, this is why these types of tools, we see them as potentially interesting for public sector, for towns, for communities, because you don't have to deal with lawyers or disputes. You know, we download the data from the internet. This is a NOAA-provided website. The NOAA website is in the contract. The protocol to get the data is in the contract. There's very, very little room for dispute, right? All the steps are very clear there. There's no subjectivity. I mean, you could argue that there's subjectivity in the scientists who produce this data. Sure, but if we accept them as a referee, as an arbiter, then there's no further dispute down the road, right? And then the last feature that they have, which is also very important, is their versatility. Now, I have a friend in Sausalito, California, and he sent me a picture, you know, after the rains that they had. He sent me a picture of a pile of dirt, right? They live on the hill. Because of the rainfall, a lot of dirt had fallen, and they had a mountain of dirt just 5 inches from the wall of their house, right? I mean, thankfully, it didn't affect the house, but you know, now they have this big mound of dirt. Of course, they called the insurance company, and the insurance company said, well, you know, this is not covered by the policy. This is a flood-produced landslide, and that is excluded from the policy. I'm not criticizing the insurance companies here, right? We often, I mean, I have read my policy when we had a problem, but until I had the problem, I didn't have the interest, the time. You know, it's not a fun thing to do, to read the policy and scrutinize all the clauses, right? But in general, what happens is that, you know, we don't read them, or we accept those exclusions. We also don't expect the insurance company to cover us from anything. We know that there's going to be some things they're not going to pay for. But in a time of need like this, it really hurts, right, to know that you're on your own, especially if you've been paying them for years chunk of dollars, you wish, well, I wish I had saved them and have them in my pocket, right? So I wish I had done risk retention instead of this risk transfer. So these tools, what I told my friend, and this is something I'm going to do in my town. I live in Pelham, New York, just north of the city, and we had damages from Hurricane Ida. Hurricane Ida hit in Texas and then crossed the whole country, right, and turned up in New York. And it was not a hurricane anymore, but it produced enormous amount of precipitation. Our property, right, we're a little bit of a low point, so we got a foot of water in the basement. It's no big deal. We have a pump. It flew out eventually, but our dryer was dead, right? So, and I was thinking, some of our neighbors had a ramp where they parked the car. Those cars were totaled. I want to go to my town. I want to say, guys, let's buy a rainfall index so that we can measure. We suffer from rainfall. I know it's going to take years to build a new sewage system. In the meantime, why don't we buy $1 million for the town to be covered in case there's extreme rainfall, and we have to get from this fund small grants so that people, buy a dryer or a washing machine or what have you. I think there is potential in these things because they're patches. This is not solving climate change, right? But they provide us with a way to transition to a riskier regime. It's just one more arrow in our quiver. And they're super versatile because once you get the money based on these contracts, you can use it for whatever you want. Remember, an insurance company will give you rules on how you use the money. They will say, this is for your wall. And if it's not a wall damage, I'm sorry, it's not covered. This is money you get in your pocket if the conditions are fulfilled. If that index says 400, it's 400. That's what you get. And how you use the money is not an issue anymore, right?
What's the distance measuring? Distance from the land?
Yeah, so the distance here on the horizontal axis, this is the distance that the hurricane has traveled. Yeah, so as it moves, basically we're following along the axis of the hurricane, right? So as it moves, the wind speed changes. You see that the red dots in the top map coincide with peaks in the wind profile in the second plot. And then as it hits the red area, which is the coverage for, in this case, Chatham County in Georgia, then the loss starts spiking, okay? Yeah.
When determining basically your diameter of disaster,
Yeah.
earthquake occurs in this
Yes.
area.
Yes.
How is that boundary determined? Does the insurance or reinsurance determine that obviously based on risk, and then put that out there as a product, and then the town, the individual, whatever says, okay, I want to buy into this or whatever? Or is there a negotiation between, hey, we want to include an extra 30 feet up the coast this way, and this way not so much?
Great question. Let me show you how these things are built, right? That will answer your question. So in this case, I'm going to show you the process of construction for an index in Florida. We're going to see how it works. What we do is we run a model. We have a model, like NOAA has a model on which they produce the forecast. We have a model too. These are commercial models. We buy them. Other insurance companies buy them. There's 3 or 4 providers in the industry who develop models for Florida. Actually, Florida is a pioneer in public scrutiny of these models. Because, the insurance industry was telling Florida, hey, my model says that the losses could be up to hundreds of billions. And Florida at some point said, you know what? Stop this nonsense. We're going to review your model. So they created a panel, which is now famous, right? It's called the Florida Commission. It has a longer name for loss prediction and something else. But they basically hire a team of scientists. And I'm sure some of you here are involved, right, Bob? So they hire a team of experts to scrutinize the scientific models that are used to specify risk and rates. And they, companies go through a process. It's an exam. If they don't pass the exam, that model cannot be used for risk transfer in Florida. That's also a very good step that Florida took. I think we should have that for California earthquake too, for example, right? That's great. But that based on those models, we create this grid. We basically create, these are simulations of hundreds of thousands of hurricanes. They're stochastic, they're simulated by a computer based on history, based on physics. And then we calculate the loss of each of these hurricanes. And what you see here is a correlation calculation of the loss in each hurricane according to the cells that it crosses. It takes a while to kind of process it, But basically what we're saying is, look, if there's a hurricane crossing through here, you see that the reddest cells are around Miami. Why? Because we have a lot of exposure there, right? Exactly. So, and the correlation with loss is highest in Miami. I mean, if a hurricane goes through Miami, it doesn't really matter that later it goes north or south. It's going to be bad, right? So that's what this diagram is telling you. On the West Coast, you see the same kind of stuff, right? I mean, if the hurricane did like Ian and went and hit these redder spots, Fort Myers, Tampa, then you see that also that would drive the loss, right? So what we do is we let the hurricane run through this. We compute the damage according to each cell, and then we compute a weighted average according to the exposure, according to the correlation. What you're seeing here is brand new. I mean, we brought it to market in 2020, and it's an example, right? If we are doing this, Swiss Re is doing other stuff, Munich Re is doing other stuff. I mean, at the moment, they like what we're doing, so they're working with us. But I mean, companies will arise that will create these and other variants. But that's how we come up with the geography and the domain with a model.
But you're still producing your end product then is your accepted risk and payout in diameter, and then you're offering that as a product to be bought as is.
Yeah, so yes, but you also ask if there's a process of negotiation, and the answer is also yes. Because we bring this, normally this is our first point of contact, right? If we had to talk to the state of Florida, we would bring this, we'd say, look, this is calibrated to Florida. And they might say, well, what if we want to focus this tool only in Miami? But we would recalculate it with them only for Miami, definitely. Please. Yes. Yes. So basis risk is defined as the difference between actual experienced damages and the recoveries from the parametric tool. Example, a hurricane comes, and the hurricane is going to pay you if it's a category 4 or higher. Now, the hurricane was a category 3, but for some reason, it destroyed your house, right? So now you go to your policy and you say, well, I'm paid for a category 4, so you're not going to get any money. That is what we call negative basis risk. It's basis risk that affects you with a default. You don't have enough money, right? The opposite could happen too. You could have the policy, and you could have a hurricane category 3, a category 4, right? Your policy pays, but hey, you were lucky, so nothing happened. So now you have windfall, so to speak, right? There is some subtleties. If you buy the product as a derivative, that's fine. You can get the windfall and go on vacation. If you buy the product as an insurance policy, you cannot accept that money technically because you're not spending it in offsetting your losses, right? Although now we make them so flexible that if you said, look, I had to go to my family's house in New York because of those damages would be justifiable for the policy. Yeah. Yes. Sorry? So, yep.
Yeah, same question. My flood insurance rates tripled this year.
Yep.
And so I'm wondering, as an individual investor, is there a way to invest in this parametric thing to hedge your bets?
Yeah, I mean, excellent question. Look, I toured the financial markets in 2017 with these concepts, looking for investment, looking for partners who would be willing to invest in these systems, and also making it possible for people to put their own money within the investment system. There's willingness in the market to do things like that. I am 100% sure that it will appear. We will have that. And as a matter of fact, we're looking into mechanisms to do that. But the regulatory environment is still a little bit strict. These are new tools. The regulator needs to understand them. The regulator is trying to protect you, right? And trying to make sure that you don't invest in something that you don't understand. So that's why, for now, they're restricting these types of investments for what they call qualified investors of 100 million assets and more. But in the future, I think this is going to be much more liberal.
I have a question.
Yeah.
Most of us here have experienced the Florida real estate market, and anybody can understand that insurance rates will go up if there's a perception that there are worse hurricanes or more hurricanes. I mean, that clears the market that we all understand. But it seems that in Florida, the hurricane insurance market didn't clear for a while. And was this that if you're sitting in Zurich at Swiss Re and somebody tells you all of a sudden a bunch of people lose a couple of shingles and the trial lawyers get rich and we transfer the money from wealth and you say, I don't understand this world, the hell with it. I ain't dealing with these people. Or is it, wow, that hurricane cost us so bloody much, I don't know what to think. I'm out of here. Why the distinction between higher prices appropriately moving higher to be a proper discounting of newly evaluated risk, that I understand. But what happened in the insurance market that made it seem disorderly and not clearing?
Yeah, no, you're right. It's a bit of a mess, right? Because there are lots of forces at play. I mean, it's a very complicated system because the money has many paths to move, right? For example, in Florida, I sometimes, I'm from Spain, from Europe, we know what a socialist country is. And, I laugh sometimes when they tell, no, at Florida, not socialist, totally. But, in risk transfer terms, you guys have a very socialistic system because you have citizens, right? Florida citizens is a socialization of hurricane risk. And I'm not opposed to it. I think socialization of risk is a good thing to consider. But it is what it is, right? What is happening is that because there's not a private market that is supporting insurance in Florida, people are flocking to citizens. Citizens is subsidizing risk because citizens, the mission of citizens is to make insurance affordable. They cannot decline people, right? So now you're selling policies at below risk rate. It's your state mandate, you have to do it. But well, who's going to pay for losses? So they have been losing money, and every year at this trend, they will lose more. So who's paying for that? Well, ultimately the state. So taxes of the whole state, right? So it's a socialization of risk, because the existence of Florida citizens, the rest of the market doesn't also function as a market, right? Because now, well, that. Well, if you charge too much, they're going to go to citizens. So, this is not real competition. So this dynamic mechanism is very, very complex. But you got it right that the general scheme that they see from Europe or, from Swiss Re or Munich Re or these guys, what they see is increasing risks, messy legal situation, complex dynamic, and some of them say, I can make money out of this, right? And they say, I'm going to raise prices. And hey, whoever buys. My coverage is expensive. Some people, most of the conservative big players, they just remove themselves. So some people I talked to in London, they said, Florida risk, but Philippines, great, Indonesia, great, a little bit of Japan, but they are retreating from Florida because of all these drivers. That also, I recommend a book that changed my how I look at financial systems. It's a book called The Poor and Their Money. It's written by a scholar in London, Stuart Rutherford. But he describes all these mechanisms, financial mechanisms that tribes and ancient civilizations used to pool risk. I think now the financial systems in insurance, in some places are so complex that we're going to have to go back to basics. We're going to have to go back to a system where you guys say, look, we're getting crappy rates from the insurance world. They have other things to invest in, so they're not attracted. We need to collectively group up, band up, and create a product that we believe in that serves us. So it's more a community-driven movement. I think there's going to be a lot of communities that are going to look into this because the alternatives are not great, right? And these types of products will support that because now as a community, you can buy something like this. The friction is minimal. You guys don't have to have trust in whoever sells it to you because it's Noah. It's whatever Noah says, right? You need to have trust in how it's built and all these things. But all of these tools are going to make it easier to go back to basic, simpler, community-driven mechanisms. That's my guess, because the capacity in the insurance market is not going to grow fast enough to sustain the demand.
So is the functioning of the Florida market getting better or is it getting worse now?
Well, it's getting better from the side that, the regulation that was passed, well, that's helpful. That eliminates that third driving factor, right? The legal issues. That's positive. From a risk perspective, there's going to be more pressure because the trend is not positive. Somebody asked me, oh, will insurance insure sea level rise? No. Insurance will not insure sea level rise because sea level rise is a new normal. And insurance cares about the peaks, right? The extremes. Sea level rise is not an extreme. It's not a peak. It's a new regime. I think there was a discussion before about whether insurance companies price climate risk. Mostly no. Why? It's not that they don't care or they don't know. It's just their minds are driven by 1-year policies. And to them, they're using models that are updated with a cycle of 5 years, 5 years. So and they say, the enlightened ones, they say, I'm gonna consider climate because this trend, my prices will go up a little, but then the market crashes them because their competitors are not doing that. So they are forced to go back again. So pricing climate change in insurance is either not done or extremely complicated. I'm going overboard here, no?
I mean, I could listen to him all day. Thank you so much.